that this fear that inflation at 7%, which is the CPI right now on a year-over-year basis, is getting embedded into the system because wages are rising and so forth. So what we're seeing on the monetary and fiscal front right now is effectively significant tightening already. On the monetary front, we've seen money growth go from 27% at its peak during the coronavirus, the depths of the coronavirus, to 13% recently. But if you look at it a little more closely and in a shorter term time horizon, we're down to 8% growth on a 3-month basis, 6.5% on a 2-month basis. And we believe that money growth will continue to slow quite significantly, especially if the Fed does raise interest rates. Now, we wouldn't be surprised to see the interest rates go up in March. Many people, after today's employment report, are beginning to think that 50 basis points is the number, that the Fed will basically telegraph that it means business and that it's going to head inflation off at the pass. They may do that. If they do, however, we think the stars are aligning in such a way that they will get the message very quickly that they don't need to do much more. Another break on them is, a political year, the midterm elections. The Fed does not like to get in the middle of midterm elections, doesn't want to be accused of any political dynamic. So they might want to do the 50 basis points just to say, okay, we're done for a while. Now, what's interesting about the market's reaction to this possibility is that strategists out in our world are now trying to leapfrog each other, saying, okay, I think it's at least 3 more tightenings after that, or 4. I've even heard altogether 7. So the reaction you've seen in the equity market recently is fear, I think, that the Fed is going to go too far, too fast, because as I will go through in a minute, the economy is quite weak. And I think the Fed could overdo it quite quickly. What economists and investors did focus on, rightly so, was average hourly earnings, up 0.7%. And on a year-over-year basis, that takes them to 5.7%. So hence the fear that, oh my goodness, inflation is now feeding into the wage structure. We believe that what's happening is the labor force has been impacted severely by the coronavirus and its variants, and things are still sorting themselves out. But one thing to note is that 5.7% is still lower than that 7% CPI. So real purchasing power is going down right now. We are seeing some indicators that are earlier in the pipeline, like the PPI surprised on the low side at 0.2%. Import prices fell by 1.8%. That would be export prices. Import prices fell by 0.2. So we're beginning to see earlier in the pipeline signals that inflation is going to come down at some point in the future. It may get worse on a year-over-year basis before it gets better. But again, we are very focused on the pipeline.